Again, welcome. We're glad you're joining us today for today's webinar. Before we move along with our session, let me just make sure you're in the right place. Today's webinar is Practical Considerations Form 1116. And this webinar is scheduled for approximately 120 minutes. Let me introduce today's speakers. Maria Nicolau and Jim Wu are both senior revenue agents in large business and international, specifically in its withholding, exchange, international, individual compliance division in the Foreign Tax Credit Practice Network. Maria joined the IRS in 2003 and Jim joined in 2010. Both are technical specialists with extensive experience focusing on the foreign tax credit for individuals. So Maria, if you're ready, I'm going to turn it over to you to begin our presentation.
Thanks, Mike. Hello, everyone, and welcome to today's webcast. Today, the agenda will start by focusing on an overview, which includes some foreign tax credit basics, the foreign tax credit limitation, and some foreign tax credit concepts. Now, we're having this webinar because in last year's webinar, we had a lot of questions about the form and line items. So, having said that, we will spend some time on the Form 1116 itself. And we'll also include discussion about the new Schedules B and C that are available starting on 2021 returns. And to tie it all together, we have an example of parts of a sample tax return where we can follow some of the items we reviewed today and carry that information into a Form 1040 with a Form 1116. Now, most of you are aware the IRS loves acronyms, so today's topic is no exception, but we've kept it short and sweet here. The first, FTC, is Foreign Tax Credit. The other acronyms include Worldwide Taxable Income, WWTI, Foreign Source Taxable Income, FSTI, and U.S. Taxable Income, USTI. So, like I said, we always start with some overview. The code sections for FTC are found predominantly in code sections 901 through 908. And this slide shows what's considered to be the tripod of FTC concepts. And that includes, first of all, the taxation of worldwide taxable income of U.S. taxpayers, which includes citizens and residents, as well as domestic corporations. And it's the most defining characteristic of our U.S. tax policy. So what happens when income is taxed both by the U.S. and a foreign country, referred to as double taxation? Excuse me. Relief can be offered through two possibilities, through a credit or some treaty treatment. We won't be discussing treaties in this event, but they must always be considered. The FTC is the primary mechanism through which the U.S. provides relief. The FTC allows a reduction of U.S. tax on foreign source income by all or part of the foreign taxes paid or accrued during the year. However, FTC does not reduce U.S. tax on income unrelated to those foreign taxes paid. That is a key point. The FTC also has a limitation, and the relief can only be claimed for qualified foreign taxes paid or accrued on foreign source income, and it can be limited. The full amount of the foreign income taxes paid or accrued will not necessarily be the amount of the FTC for that year. And that is because the allowable credit is limited. and it is the lesser of 1, the amount paid or accrued, or 2, the overall limitation on the foreign tax credit. The limitation treats all foreign income in specific categories as a single unit and limits the credit to the U.S. tax attributable to the foreign source taxable income. And FTC rules include more rules requiring that the limit be applied to specific categories of income. And we'll get to that in a little bit. So, Mike, if I'm not mistaken, I think the polling question is up to bat.
It absolutely is. Thanks, Maria. All right, audience, I hope you are ready for our first polling question. You should see that coming up on your screen now. And that question reads, why is the credit allowed only for income taxes? And your options are A, the purpose of the credit is to eliminate double taxation of income. B, property taxes may be creditable under certain circumstances. C, some foreign countries do not have an income tax. Or D, none of the above. So take a moment and click the radio button that best answers the question. And I'll give you all a few more seconds to make those selections. Okay, we're going to stop the polling now, and we'll share the correct answer on the next slide. Okay, and as you can see on your slide, the correct answer is A. The purpose of the credit is to eliminate double taxation of income. Let's see how well you all did with this question, and let me just check with our team here while we pull up those numbers. So thanks everybody for answering that. Okay, it looks like still got some data coming in, so just give me a few more seconds here. Okay, it looks like 94% of you answered correctly. A, the purpose of the credit is to eliminate double taxation income. So, all right, thanks, Maria. I believe it is back to you.
I believe so myself. So we're going to move on to the second agenda item and talk about this FTC limitation. Congress was worried about tax-motivated opportunistic behavior. So what they did is they created provisions to prevent foreign income taxes from reducing U.S. income taxes on U.S. source income. And while foreign taxes are creditable under 901, if the taxpayer elects the credit, the FTC, then they are limited under Section 904. We've heard time and time again the purpose of the FTC limitation is to prevent foreign taxes from offsetting the U.S. tax on U.S. income. In other words, it's not the U.S. national tax policy to subsidize the levies of foreign countries, but to provide relief only where double taxation exists. So FTCs are limited annually to the amount of U.S. tax on FSTI, foreign source taxable income, as computed under U.S. tax principles. The amount of the taxpayer's FTC is the lesser of 1, the credible foreign income taxes actually paid or accrued, or 2, the FTC limitation. In other words, the creditable foreign taxes paid or accrued by a taxpayer, and if the creditable foreign taxes paid or accrued by a taxpayer in a given tax year exceeds the taxpayer's FTC limitation, the taxpayer cannot take a credit for the excess. The maximum FTC allowed is often expressed as a formula you see here. Foreign source taxable income divided by worldwide taxable income before exemptions gives you that fraction of foreign source income to the whole, and you multiply this by the pre-credit U.S. tax liability. So if a U.S. person pays more tax to the source country on the foreign source income than would be due to the U.S. on the same foreign source income, the U.S. is going to limit the amount of taxes paid to the source country that can be used as a credit against our U.S. tax liability. But all is not lost if you're limited. In certain circumstances, a taxpayer's foreign income tax is not credited because of the limitation, can be carried back or forward, subject to limitations for those other years. Now, although all worldwide income is generally taxable, the source of that income is important because the FTC is limited to that part of the current year U.S. tax, but again, only on the foreign source income. The amount of the allowable foreign tax credit, or the FTC limitation, is ultimately computed based on the percentage of worldwide income that's foreign source that you saw on the previous slide. If U.S. source income is erroneously included in the foreign tax credit computation, there is a potential to overstate the foreign tax credit, and that could result in a reduction of U.S. tax on U.S. source income, and we don't want that. So let's start to apply these concepts to the form itself. Here you see the top of section Form 1116. It states right under the name and TIN to use a separate Form 1116 for each category of income below. It also states to check only one box on each form. What this top section with all the boxed choices does is to address the 904D, Code Section 904D requirement, which says you must compute a separate FTC limitation for each separate category, or sometimes they're referred to as baskets of income. And this is done to prevent the blending of high foreign tax rates in excess of the U.S. tax rates with the lower foreign tax rates to get an overall foreign tax rate below our rate. So a Form 1116 must be completed to determine the FTC allowed for each separate category. And we now have 7 categories for which a separate limitation must be calculated. So we're going to briefly go through these. The first 2 are the newest ones added by the 2017 Tax Cuts and Jobs Act, also known as TCJA. So first up, we have 951A category, which is Global Intangible Low Taxed Income, also known as GILTI. And it was a new category beginning in 2018. A 10% or more U.S. shareholder of a controlled foreign corporation, or CFC, is required to include certain income received under Section 950A, other than GILTI, that is passive income. Foreign tax related to GILTI income is an indirect foreign tax credit and reportable on Form 1118, Foreign Tax Credit for Corporations. Our second category, foreign branch income, is the other new category beginning in 2018, and it consists of business profits of a U.S. person that are not attributable to one or more qualified business units, or QBUs, in one or more foreign countries. Again, this category does not include any passive category income. A very common one is the passive category income, and it's what you would expect it to be. Dividends, interest, rents, royalties, annuities, net gains from sales of non-income producing property, income-producing investment property or property that generates passive income. Also, net gains from commodity transactions, amounts included as foreign personal holding company income, and amounts from passive foreign investment companies, or PFICs. One thing that passive income does not include is high-taxed income. If the foreign taxes you paid on the income, after you've allocated expenses, of course, exceed the highest U.S. tax that can be imposed, it will generally be treated as general category income. And this is what we refer to as the high tax kickout, or HTKO. And we'll talk more about that. The next category, general category, is our next most popular one. It's income from sources outside the U.S. that do not fall in any of the other separate limitation categories. It generally includes active business income, as well as wages, salaries, overseas allowances of individuals who work overseas as an employee. It also includes high-taxed income that I just mentioned that would otherwise be passive. Next, we have Section 901J category, and that is income earned from activities conducted in sanctioned countries. Now, each year, Pub 514, FTC for individuals, lists these countries. Income derived from each sanctioned country is subject to a separate foreign tax credit computation. And we emphasize making sure you use the correct year's publication, because which countries are on bad terms with the U.S. has changed over time. Some go off the list and some are added to the list. So always make sure you're using the right year when you're looking at forms and instructions. The next category, certain income resourced by treaty, is when a treaty treats the sourcing of income in a different way than the general U.S. sourcing rules. If a sourcing rule in a treaty treats U.S. source income as foreign, and the taxpayer elects the benefits of the treaty, the income would fall under this category as foreign. What this means is if a taxpayer elects to apply the treaty, and the treaty allows the other country to tax that income that is from the U.S. source under U.S. source rules, the U.S. must treat the income as from foreign source. Now, we want to make everyone aware that resourced by treaty is not the same as certain income affected by reduced treaty rates, which stays in the passive basket. And we'll bring that up, I think, a little later. Lump sum category applies to any income a taxpayer receives from a foreign lump sum distribution retirement plan, and the taxpayer figures the tax on it using some special averaging treatment for lump sum distributions. The taxpayer needs to make a special computation according to the Form 1116 instructions and report it as a separate category. We seldom see this, but it does exist. Now, Part 1 of the 1116 is where foreign taxable income and loss are calculated. There we go. Maybe my computer's slow. Think of it like this. The 1040 is your worldwide taxable income, right? It starts with income, and it's followed by either standard deductions or itemized expenses, and it ends with taxable income. So think of the Form 1116 as the foreign subset of everything on the 1040. It also starts with income, and then further down addresses deductions and losses, and ends with foreign source taxable income on line 7. Some things we want to point out with the time frame we have here. Everyone should utilize instructions to Form 1116 and Pub 514 FTC for individuals. These two resources can give you all the guidance you need, but we're just going to summarize some areas of key non-compliance that we sometimes see. First, each country should be listed in line 1, columns A, B, and C. If you have more than 3 countries, you should attach another Form 1116 for that category. Line 1A includes income in the category checked above in Part 1 that's taxable by the U.S. from sources within the country you listed in the columns. You must include the income even if it wasn't taxable by the foreign country. Remember, the U.S. taxes worldwide income. You would describe it on the lines to the left. Now, one thing we see, if you have a general category form, you would not include any earned income excluded on Form 2555, foreign earned income. If you excluded this income, it should not be included in the FTC calculation. So you would need to reduce the gross by the FEIE taken. And that net number goes off to the right in cell 1A there, line 1A off to the right. Now, if we're talking about the passive category form, and any foreign source qualified dividends or capital gains income exist, you should reduce that amount to reflect any required foreign source capital gain and qualified dividend tax adjustment. And I'll briefly talk about this adjustment because it's required due to the preferential tax treatment of capital gains and qualified dividends. So taxing the capital gains and qualified dividends as at a lower rate, think of it like this, taxing the capital gains and qualified dividends at a lower rate is the same thing as taxing part of the income at the full rate. So only the part that is theoretically taxed at the full rate should enter the 904 limitation calculation. So the capital gain qualified dividend rate differential adjustment is only applicable when the capital gain rate differential exists. There are even more nuanced rules for non-corporate taxpayers and de minimis elections. So we suggest everyone refer to the regs under 904, the instructions to the form, and the pub for more details on this. Another thing under the passive category income, we talked about this high taxed income. It will be treated as another category. So what you would do in the description is it would show HTKO, high tax kickout, on line 1A, and a negative number would be put there. Then on the other category of income, the general, the high taxed income would be entered there with HTKO and a positive number on line 1A. Line 1B we don't see too often, but it says if the foreign source income you earned as an employee and is more than $250,000 or more, and you used any alternative basis, you would check the box. And this refers to the way compensation is sourced when both U.S. and foreign, and it's based on normal facts and circumstances of the normal sourcing rules. Again, Pub 514 and the instructions have details if you come across that scenario. So continuing on Part 1 of the Form 1116, this section is where foreign gross income that was reported just above is reduced by deductions and losses working toward that line 7, foreign source taxable income. Now, often this section is blank or understated. And what that does is it increases the percentage of the foreign source to the total. Line 2 contains allocated expenses that are definitely related to the foreign income. For example, if you have a foreign rental and you have income on your passive category form, then expenses related to that rental are definitely related and would go on line 2. If you have foreign business income on line 1, then business expenses incurred as part of operating the foreign business would definitely be related. Interest expense is not included here and is treated differently down on lines 4A and B, down below. Now, line 3A and 3B include a ratable share of your other deductions that don't definitely relate to your foreign source or your U.S. source income. Line 3A includes things like your itemized deductions other than interest expense or the standard deduction. Line 3B may have a deduction for alimony paid. Now, lines 4, my eyes are getting much worse as I get older. Line 4 deals with interest expense. Now, there is a de minimis rule that states if your gross foreign source income, including income excluded on 2555, does not exceed $5,000, you can allocate all of your interest expense to U.S. source. Otherwise, it needs to be apportioned. Line 4A is for mortgage interest, and 4B is for other interests like investment interest. Again, the instructions in PUB offer worksheets and guidance on that. Line 5 deals with capital losses from foreign sources. And now that takes us down to line 7, foreign source taxable income. And remember, this is the numerator in our limitation formula. Worldwide taxable income is the denominator. And as I said, we often see expenses missing or understated. And if this happens to come from flow-throughs that are prepared, you want to ensure that you've allocated appropriate overhead and shared expenses against the foreign source income. The next section is Part 2, and it addresses the 905A election, whereby a cash method taxpayer can elect to claim the FTC either on the cash basis, which is known as the paid method, or the accrual basis by checking either box J or K. Most taxpayers are on the paid method. Now, they can elect the accrual method, but once that election is made to account for your foreign taxes on the accrued method, it is binding on all future years. The general rule is if an amended return is filed and the accrual box is checked, the original return must also have been on the accrual basis. The taxpayer cannot switch to the accrual method on an amended return. Now, we want to point out that there are some new regs, and there is a very limited exception to this. And I'm going to give you that reg section. It's 1.905-1 E as in Edward 2, and that states if a taxpayer claims FTC for the first time, an election to claim the FTC on the accrual basis may be made on amended return. So let me give you an example. In year 1, we had a taxpayer who is a U.S. resident, and they had foreign source income, and they paid foreign taxes, but they never claimed the FTC in prior returns. And they did not claim FTC on the originally filed return. Okay, so for whatever reason, they did not take it. In year 2, the taxpayer learned that claiming the FTC on the accrual method would benefit them greatly. So they amend their year 1 return and claim FTC on the accrual method. Under this reg, the taxpayer's election is now permitted because the taxpayer did not claim FTC in any prior year returns and on a timely filed original return. The taxpayer did not choose a method. So this means the election made on the amended return is the first time the taxpayer chose that method to claim the FTC. It is a very narrow scoped exception. So in items L, we put the dates paid or accrued. In columns M through T, we enter the creditable foreign taxes in foreign currency and then in U.S. dollars. Item U is the total of columns Q through T. And one thing we want to point out, taxpayers should consider if all remedies have been exhausted to reduce the foreign tax. Often, when you're dealing with passive income almost always has reduced rates based on treaties. So, if there is a treaty rate that results in foreign taxes less than the amounts actually withheld, only the lower amount can be listed here. The foreign tax return will help verify if and how much may have been refunded. So if it's been refunded, it's not creditable. Or perhaps they paid additional taxes on that foreign return, entitling them to additional foreign taxes. So, Mike, I think it is time for a polling question.
It is. Thank you, Maria. All right, audience, here is our second polling question. And again, that should be popping up on your screen. And feel free to take a minute to answer this. It reads, which new categories of income were created by the 2017 Tax Cuts and Jobs Act for foreign tax credit purposes? And choose the best answer from these options you see. So A, foreign branch income. B, Section 951A income. C, both A and B. Or D, none of the above. Let me just read that again. I know everybody's on different browsers and this may take a minute to pop up for some users. So again, that polling question is, which new categories of income were created by the 2017 Tax Cuts and Jobs Act for foreign tax credit purposes? And hopefully those options are on your screen now. So take a moment, click the radio button that best answers the statement. I'll give you a few more seconds to make your selection. Okay, let's close the polling and we'll share the correct answer on the next slide. Right, and as you can see, the correct answer was C. So both foreign branch income and Section 951A income. All right, let's see how many of our attendees answered that correctly, and it looks like 79%. So 79% of you answered that correctly. Maria, that's a pretty high rate, but could you just maybe provide a little more detail about that, just so we're perfectly clear?
Okay. The first two categories, A and B, were added by 2017 TCJA. So 951 Cap A is the guilty branch. guilty category, and the foreign branch is the second category on the form. So the answer would have been both A and B.
Okay. Great to know. Let's see here. So now I think I'm going to turn it over to Jim to continue with the presentation. So Jim, if you're all set, the microphone is all yours.
Thank you, Mike. I'm going to now continue going down the Form 1116 from where Maria left off. And I want to highlight some items in Part 3 of the Form 1116 that deserve some explanation. Some of these line items are self-explanatory, such as line 9, which carries over the amount from line 8, or line 11, which combines the current year and either carry back or carry over foreign taxes. Later, I will talk about line 10, which has a new schedule, Schedule B. Going down, line 12 is reduction in foreign taxes. You may have to reduce foreign taxes that you paid or accrued. The instructions list several items, but we want to focus on foreign taxes on excluded earned income under Code Section 911. Just as foreign source gross income on line 1A of the Form 1116 must be reduced by the amount of the Section 911 exclusion, the related foreign tax needs to be reduced as well. The reason for this reduction is simple. Because the taxpayer has excluded a certain amount of foreign source income from U.S. taxation, the related foreign tax must be excluded as well. Obviously, there is no double taxation when a portion of foreign source income is excluded from being taxed by the United States. Therefore, the taxpayer cannot claim foreign taxes paid or accrued for FTC purposes on income excluded. And later on, we will have an example. Going down to line 13 is taxes reclassified under HTKO, or high tax kick-out. As Maria mentioned previously, if a passive income in a foreign country is taxed at a rate exceeding the highest U.S. rate on that same passive income, then it gets kicked out of the passive category and reclassified to the general category. This is done again to ensure that the foreign income does not result in reducing the U.S. tax liability of the filer. I would refer you to Treasury Reg 1.904-4C. In other words, foreign tax credits cannot be used to reduce U.S. tax on U.S. income because the purpose of the FTC is to reduce U.S. tax on foreign income, not U.S. tax on U.S. income. The limitation to the FTC, as expressed on line 21 and 24 of the Form 1116, supports this principle. The Form 1116 instructions provide the mechanics of how the reclassification is done. In a nutshell, the high tax passive income on page 1, line 1A, is backed out of the passive category, Form 1116, as a negative, and then added to the general category, Form 1116, line 1A, of the relevant column, and then HTKO should be notated on that form, the letters HTKO. Line 13 on page 2 addresses the foreign taxes paid or accrued on that high tax income. Okay, going down to line 16 is another area of the Form 1116 that gives a heartburn to a lot of people. if you have to make an adjustment to the foreign source income, plus or minus on the Form 1116, line 16 is where that would go. The instructions to Form 1116 have a very helpful example on this. A lot of taxpayers miss this adjustment because what they don't understand is that when there's a net loss in one income category, for example, a net passive category loss, that loss must be allocated to the other categories with net income. And where there's an overall net foreign loss from all categories or baskets, that loss will need to be allocated to the U.S. taxable income. And then if there's an overall domestic loss, that loss must also be allocated to the foreign income baskets. Any loss that is allocated in 1 year is required to be recaptured in the following year when income is derived from that category. This trading of losses and recapture in later years is there to prevent FTCs from being used disproportionately. This is a very complex area of the foreign tax credit. We do, however, want to point this out so you're aware of what goes on this line 16. For more information, both the Form 1116 instructions and the Pub 514 have some very good explanation on this. And the IRS has also published a practice unit on this topic of overall losses. We will circle back to line 9. I know we haven't discussed this, carryovers and carrybacks, in just a moment when we discuss the new Schedule B. All right. Moving on to the next slide, and part 4 of the Form 1116. This section is generally completed on the Form 1116 with the income category that has the largest allowable foreign tax credits. So if you have more than one Form 1116, leave the other Form 1116 blank for this section. All the allowable foreign tax credit for different income categories will be summarized on one Form 1116. Again, the one with the largest allowable foreign tax credit. Once this section is completed, the total FTC goes to Schedule 3 of the Form 1040, line 1, as indicated on line 35 of the Form 1116. Now I think it's time, Mike, for our next polling question.
Sounds good, Jim. All right, audience, polling question number 3 should be popping up on your screen shortly. And this question reads, which line on Form 1116 is used to adjust the foreign taxes related to excluded income? So A, Part 1, line 1A, Part 2, line 8, Part 3, line 12, or D, none of the above. Read that question just one more time. Which line on Form 1116 is used to adjust the foreign taxes related to excluded income? Right, take a moment and click the radio button that best answers that statement. I'll give everyone just a few more minutes to make your selection. Right, we are going to stop the polling. We'll share the correct answer with you on the next slide. And you should be able to see the correct response was C. So Part 3, line 12, reduction in foreign taxes. And give me 1 second and we'll see how we did on that one. Okay, so that one was a little tougher. I was going to give you a tip, look back through the materials to check on that. But so Jim, it looks like our correct response rate for that one was 54%. So are you able to elaborate or give us an idea of any more details on this?
Yeah, obviously, as you show on the slide, the answer is line 12. And we did discuss this in one of the slides previously that when you're adjusting for the foreign taxes related to the Section 911 excluded income, the foreign taxes that are being reduced related to the exclusion should be on line 12, part 3. And that's what that line is there for. So hopefully that clarifies a little bit.
Yep. And highly technical material. You guys are the experts, so thanks again for kind of going over this in detail with us. So, all right, Jim, I'll hand it back to you, and it is all yours.
All right, thanks, Mike. So continuing here, I want to spend a few minutes talking about the new Schedules B and Schedule C. These two new schedules are additions starting in tax year 2021. First, the Schedule B. Prior to 2021, taxpayers were instructed to attach a detailed computation on line 10 of the Form 1116. Schedule B now standardizes what should go on line 10, both the carryover and carryback of in-use foreign taxes due to the limitation. Section 904C allows unused foreign tax credit to carry back 1 year and forward 10 years in that order. And the carryback is mandatory. It's not elective. This schedule looks a little bit intimidating at first. It has so many lines and columns and rows, but it does have a logical flow. Amounts to enter on line 1 is taken from the reconciliation worksheet from the Schedule B instructions for the 2021 tax year. This number represents the carryover amounts from the prior years. Note that this reconciliation worksheet is only used for the first year the Schedule B came online, which again is 2021. Or if in the succeeding year you need to amend the 2021 FTC, you would then utilize this reconciliation schedule. Otherwise, for years after 2021 and succeeding years, the carryover balances would just transfer from the prior year Schedule B. Page 2 of the Schedule B is a repeat of the page 1 to account for carryovers from the first to the fourth preceding tax years from the perspective of the current tax year. Of course, page 1 accounts for the other preceding years 5 through 10. Remember, unused or disallowed foreign tax credit from any 1 year is allowed to be carried over for only 10 years. The schedule conveniently shades out all the boxes you don't need to avoid any inadvertent mistakes. The other observation I want to make is that Schedule B is a mirror image of the Schedule K of the Form 1118, which is foreign tax credit for corporations. The Schedule K has been around for a long time, and finally, the service decided to adopt this schedule for the Form 1116. One final point. If you compare the very top of the Schedule B, where the boxes represent the various category of income, to the top of the Form 1116, you will notice that the Schedule B is missing one box, and that box being the Section 951 Cap A category, or GILTI. And the reason for this is carrybacks and carryovers are not allowed for GILTI category income per Section 904C. Now I want to spend a little bit of time on the Schedule C, Foreign Tax Redetermination. The 2022 version is not yet available when we were preparing for this webinar. So on the slide, you will see the 2021 version. And in this webinar, we're not discussing foreign tax redeterminations in any depth, but I do want to give you a brief synopsis to help with the discussion on the Schedule C. Anytime the amount of your foreign taxes change, either due to a foreign audit or because you received a refund from a foreign government after you had already claimed a foreign tax credit, it is considered a foreign tax redetermination event, or FTR. In almost all cases, you will need to file an amended return 1040-X with an amended Form 1116 to correct your original claim. So with that in mind, let's take a look at this new schedule. The purpose of the schedule, again, is to identify and track any foreign tax redeterminations in the current year that relate to a prior year or prior years. The instructions to this schedule is pretty concise, only 2 pages. And as with Schedule B, it looks a little bit intimidating at first, but as you work through the schedule, it should become easier. And I do want to highlight a few items, starting with page 1. On top of the form here, there's a section to indicate the type or category of income. And this should correlate to the related Form 1116. Part 1 is used for taxpayers who use the accrued method. And when there is an increase in foreign taxes they paid during the current year. This is because the relation back concept applies only to accrued method taxpayers when there's an increase in foreign taxes. The additional tax they paid in the current year relate back to a prior year or prior years. Starting on page 2, notice the description to Part 2 is a little bit different from Part 1 in that here you have paid or accrued when accounting for a decrease in foreign taxes. The reason for this is when there is a decrease in foreign taxes and a refund is issued by a foreign government, the taxpayer needs to relate that decrease back to a prior year, whether the taxpayer chose to use the paid method or the accrued method. There's also a difference in column 13 between Part 1 and Part 2. Presumably, when there is a decrease in foreign taxes, the taxpayer will not contest the decrease. However, when the 2-year rule is violated, causing a deemed refund, the schedule wants you to identify this in Part 2. So what is the 2-year rule? Well, for Code Section 905C2, when a taxpayer is using the accrued method to claim the foreign tax credit, the taxpayer has 2 years from the end of the tax year of accrual to make the payment. If the payment is not made within 2 years, it is a foreign tax redetermination, and the taxpayer has to amend the original foreign tax credit claim. If the tax is ultimately paid after the 2 years, there will be another FTR, and the tax paid will relate back to the year for which it was originally accrued. I want to mention one more item before moving on to the next section. In column 2B, you see reference ID in the description. And what is that? The instruction refers you to the Form 1118 instructions. In a nutshell, the REF ID, REF-ID, refers to a foreign entity for which there's no EIN. So the taxpayer must uniquely identify the foreign entity. This ID does not come from the IRS. The taxpayer is allowed to come up with their own ID as long as it is alphanumeric. And for the most part, the payer will have an EIN if it is a domestic entity. And from the individual taxpayer's perspective, the only time this might apply is if the flow-through entity in which the individual taxpayer has ownership is the payer of the foreign taxes. And Mike, I think it's time for the next polling question.
I think you are correct, Jim. All right, audience, polling question number 4 should be coming up for you. And this question reads, so on the top of page 1 of the Schedule B, Section 951A income, the Section 951A income category is missing. And why is that? I believe Jim covered this just a few slides back, so feel free to take a quick peek at your materials. I'll just read that one more time to give you some time to answer. On the top of page 1 of Schedule B, Section 951A income category is missing. And why is that? We have A, the IRS erroneously left it out. B, Section 951A income is not eligible for carryback or carryover. C, any unused foreign tax credit related to Section 951A income should be detailed on a separate schedule. Or D, there is no such income category as Section 951A income. So take a moment and click the radio button that best answers the statement. I'll give you a few more seconds now to make your selection. All right, let's stop the polling. And we'll share the correct answer on the next slide. Okay, and you should be able to see the correct response was B. So Section 951A income is not eligible for carry back or carry over. It is not on the top of page 1 of the Schedule B. And let's see how we did on that one. Okay, it looks like correct response rate there was 66%. And again, very technical material. So Jim, can you give us anything further on this polling question or a little more explanation?
Yeah, this is just by statute. Of all the categories of income on the Form 1116, Code Section 904C states that the guilty income, 951 Cap A, is not eligible for either carryback or carryover. So that's the short answer.
Okay, thanks for that explanation, Jim. And I think that does help and gives our audience something to consider. So, all right, it looks like, Maria, we will be continuing with you. So if you are all set, it is all yours.
Thanks, Mike. Now we're finally going to go through an example. So we want to list some facts here of the 1040. The preparer would also have the information to source part or all of every item as U.S. or foreign source. And this is critical to prepare the 1116. As I said earlier, the 1116 is a subset of the 1040, and it's the foreign portion. So let's go over some of these facts. Married filing joint taxpayers are U.S. citizens living abroad in France. Husband is employed by a U.S. company and works in France all year, barring vacations. Wife frequently travels to the U.S. where she owns and runs a small crafting business. Husband has both U.S. and foreign wages. Wife has a Schedule C in the U.S. Taxpayers have Schedule E rental on a foreign property. They have some various portfolio items and a K3 from a partnership and another from an S Corp. And they itemize their deductions. And remember, the K3 is a new schedule beginning in 2021 that supplements the K1 and giving us more information. So I think this next slide, this and the next slide, we're going to show the passive. I'm waiting for my screen to, there we go. Okay, so we're saying here, there are a lot of facts, but we're saying here the taxpayer has passive category income and has foreign source income from artwork, capital gain distributions, some rental income, 1099s and K3s. They have a lot of good passive stuff. So first of all, the one thing you want to make sure is that the capital gain and qualified dividends were adjusted to reduce the gross by a rate differential. So the number that you see on line 1A to the right, oops, the number, I kind of jumped there. The number on line 1A should have been reduced. So now this slide shows the lower portion. So you work through all the computation. They paid some foreign taxes. So we just want to show you how all of this flows. So in the lower section here, this is part 3, I believe. Yeah. We show that the FTC is $22,852. Okay, so that's the passive that is allowed. Okay, so if we move to the next slide, we have a general category. So we're not going to go through every line item on this. We just want you to see how everything flows. So it shows foreign source income from wages, and we say that's from Form 2555. Now, those wages would have been reduced by any FEIE taken so that the number on line 1A is the net. Okay? Now, if we continue down to part 3 of the general category, if they had a 2555, they also, on line 12, because they excluded some foreign source income by taking the 911, they would also have to reduce the foreign tax related to that excluded income, and that is what line 12 shows. So you always want to look for that as well. So if we go further down, for the general category, we have 80, on the top box there in red, 86,450. Now we have multiple 1116s. And as we mentioned, you want to take the one with the largest FTC. In this case, it's our general category, to complete part 4 down below. So you see the 22,852 goes down there, as well as the 86,450. So the total on line 35 is your foreign tax credit of 109,302. So where does this go to? It tells you right to the left that you enter this on Schedule 3 of the 1040. So now let's move over to Schedule 3 of the 1040. And that number flows to line 1, the foreign tax credit. And then there are a whole bunch of other things there. In this example, there aren't any. So that number on line 8 then will flow to the 1040 itself. And so that is the flow of the foreign tax credit. So you take all your 1116s, you add them up on the largest one. That number goes to Schedule 3. It gets adjusted for other things on the Schedule 3 if you have them, and then that number eventually ends up on line 20. So now we're going to go and look at a simple example of schedule. Let's see, no, does I think I turn it over to Jim now. Jim, do I turn it over to you for Schedule B?
I believe so.
Okay.
Yeah.
Great.
Okay. All right. So we're going to look at a simple example of the Schedule B. As mentioned, if you're doing the 2021 tax year or amending the 2021 tax year, you will want to first fill out the reconciliation worksheet that you see on this slide, which is located in the back of the instructions. Once the worksheet is filled out, that will be your total carry forwards to the current year. Again, our example, 2021. Because any disallowed or excess foreign taxes can only be carried forward for 10 years. 2011 is the 10th preceding year from the perspective of 2021. And the years still in play are right below there, line 6. And then from the worksheet, you can see that there's a total of $1,100 still eligible for carryover to 2021. And once the reconciliation worksheet is completed, the instruction tells you to carry the amounts from line 6 of the worksheet to line 1 of the Schedule B on both pages. Page 1 accounts for the 10th preceding year through the 5th preceding year, and the total of these years then gets transferred over to line 1 of page 2, which is the continuation page of the Schedule B. All right, here in column 8, Roman numeral 8, the total from page 1 is carried over to line 1. It then continues with the 4th preceding years through the 1st. Notice the total of the $1,100 in column 9, Roman numeral 14, is the same number from the reconciliation worksheet, the $1,100. In our example, we're assuming there are no adjustments to line 1. If there are adjustments, such as Section 905C redetermination, you would then input that on line 2 on this form, page 2. For simplicity, we don't have any adjustments. And the current year, 2021, also generated excess foreign taxes of $400. So the total unused foreign taxes eligible for carryover to 2022 is $1,500. $1,100 from prior year plus the $400 generated from the current year. To carry forward and use foreign taxes from 2021 to 2022, you simply transfer the numbers from line 8 from the Schedule B for year tax year 2021 to line 1 of the 2022 Schedule B. Again, I want to emphasize that the reconciliation worksheet we looked at previously is only necessary for 2021 unless you're completing the schedule, unless you're doing Schedule B for 2021 or if you're amending 2021. Otherwise, starting in 2022, you will just carry over the balance from the 2021 Schedule B. And all this is explained in the instruction. The slide shows the numbers being carried forward to 2022. What you see is the $1,500 from 2021. And it's now the beginning balance for 2022. And Mike, I think we've concluded our presentation for now. And I'm going to turn it back to you for the next part.
All right, great. Thanks, Jim. And thanks again, Maria, for all the details and going through all of this material with us. So audience, hello again. It is me, Michael Smith. And at this point, I will now begin moderating our question and answer session. So earlier I mentioned we do want to know what questions you have for our presenters, so please do take this opportunity to enter your questions into the Ask Question field that should be on the left-hand side of your screen. Simply type in your question and click Send. And do be sure to click that Send button so that we receive it. Both Maria and Jim are staying on with us to answer your questions. One thing before we start with the questions and answers, we may not have time to answer all the questions submitted, but we will answer as many as time allows. And we always want to know what questions our practitioners have about the topics that we cover so that all of your questions can be included and just so everyone knows they are extremely helpful. So please do put those questions in. And then also before we begin this, I do want to cover the continuing education details. If you're participating to earn a certificate and related continuing education credit, you will qualify for 1 credit by participating for at least 50 minutes from the official start time of the webinar, and you'll qualify for 2 credits by participating for at least 100 minutes from the official start time of the webinar. And that means the first few minutes of chatting and administrative items before the top of the hour does not count towards that 50 or 100 minutes. So, all right, let's get started so we can get to as many questions as possible. So let's see here. And just bear with me, and thank you for entering so many questions. All right, Maria, I think I'm going to start with you. And, all right, so this question reads, if the taxpayer pays foreign tax of $3,000 and the same income tax would be $2,500 if taxed as U.S. income, is the foreign tax credit claimed on the taxpayer's tax return $3,000 or $2,500?
Okay, thanks, Mike.
And some of these may be complicated and long, so let me know if you need me to reread these.
The long and short of it is the lesser of the taxes paid or the limitation. And what that would mean here is if the U.S. is only going to tax that foreign income at $2,500, that is less than the taxpayer paid, then it is the lesser of. It would be the $2,500.
Okay, that's good to know. Nice and clear, thanks. So, all right, Jim, this next one is coming to you. And again, this one's a couple sentences, so just let me know if you need me to reread any of this. All right, if an individual has less than $250 foreign tax deducted from dividend income received via trading in stock, are they required to inform partnership and S corporation that they are require Schedule K2 and K3? So let me know if
I got the question, Mike.
Okay.
If the taxpayer would like to have either a Schedule K3 or Schedule K2, I think in this case will be a Schedule K3 because it's the distributive share for the partner, then the taxpayer will want to inform the partnership or the S corporation that they want a Schedule K3, because otherwise it's possible the partnership or the S corporation may not be required to file these forms if there's an exception or exemption that they meet. So if the taxpayer wants a Schedule K3, they should definitely inform the flow-through entity. And we're going to have a webinar on the 9th, so I'm going to sort of put in a plug here. And we're going to get into the Schedule K2 and K3 in some depth, especially as they relate to the foreign tax credit.
Okay. All right. Excellent, Jim. And yeah, thanks for mentioning that webinar. That's right. just in 2 days, everyone, coming up on Thursday. Join us for that as well. Okay, Maria, this question is coming for you. And I'm going to paraphrase some of these a little just to shorten these up. So this one involves Russian tax. It reads, I have a client with an oil stock that paid Russian tax in 2022. Does that qualify for the foreign tax credit just as any other country would?
Well, first of all, I'm not going to comment specifically on any country, but there are 4 requirements to qualify for the foreign tax credit. Okay, so we didn't go over this part of it. If you're worried about whether taxes are creditable or not, I just want to, Jim did his plug, I'm going to do ours. We have what's called practice units on IRS.gov. And we have a practice unit, you can go to IRS.gov and type in practice unit. And this one's called creditable foreign taxes. But the long and short of it is, first of all, it has to be for any foreign income tax to qualify. All 4 of the following requirements must be true. The tax must be imposed or must be paid or accrued by the taxpayer. It must be imposed on the taxpayer by a foreign country or possession of the U.S. It must be compulsory, meaning it's the legal and actual liability, and it must be an income tax or a tax levied in lieu of an income tax. And that's a whole different conversation, but if it is an income tax, I know nothing about Russia. I don't know if there's sanctions, but if they are not sanctioned and they can meet these requirements, any income tax that meets those 4 requirements will qualify for FTC.
Okay. All right, Maria. All right, Jim, we're going to come back over to you. This is another long question, so please just let me know if you need clarification or any parts of this reread. All right, so this question reads, if you have foreign dividends and some have foreign tax withheld and others do not, do you include all the foreign income or just the income that has tax withheld? And then there's a second part of that question. Let me just read that as well. And what if you have other foreign income and no foreign tax? Is that other income to be included on Form 1160?
I'm going to address the second part of that question because it's a little bit easier. So if you have foreign source income and there's no taxes paid or withheld on that foreign source income, it really just means that there's no double taxation. It's only going to be taxed once by the U.S. So in that case, of course, there's no foreign tax credit to claim, and therefore you don't need to put that on the Form 1116. Now, the first part of the question reads that if there are foreign taxes withheld on some dividends, but not on others. Let me just give a simple example. Let's say there's $200 of total dividends, foreign dividend income, and then let's say on $100 of that dividend income, there's some withholding, foreign tax withheld, and on the other $100, there's nothing withheld, no taxes paid. Would you include only $100 on the Form 1116, the portion that had foreign taxes withheld, or would you include the entire $200? And the answer to that is you would include the entire $200 because all of that is foreign source taxable income in the same category, even though only foreign taxes are withheld on part of it.
Okay. All right. Thanks, Jim. Right. That provides some further explanation. A good example, too. We like to hear that. Right. Okay, Maria, you get a shorter question. All right. This question reads, What is the difference between worldwide taxable income and foreign source taxable income? Excuse me.
Worldwide taxable income is everything. Everything, regardless of where it's generated, regardless of where it's earned, it's everything. Foreign source taxable income is from sources outside the U.S. So that's kind of the short and sweet of it. And there's some rules about territorial waters and things like that, but the publication will be very useful for everyone.
Okay. All right. Thanks for that, Maria. Okay, Jim, this next one, I'm not sure if this is a exact question or just a statement that we'd like some further comment on, but this one reads, foreign tax credit mitigates the double taxation of income, but in most cases it does not eliminate it. So I'd argue the wording there is a bit misleading. Can you clarify or give us your thoughts on that statement?
Yeah, we've always said that the foreign tax credit mitigates double taxation. The reason it may not completely eliminate it is because we discussed about the foreign tax credit limitation. So in the foreign tax credit, of course, as we said, is the lesser of the foreign taxes paid or accrued, or the foreign tax credit limitation. So if the limitation for that year is lower than what was paid or accrued, of course, there's a portion there that's not given the credit. However, the portion that's not being used can be carried back 1 year and forward 10 years. Now, after 10 years, of course, it expires. So there's definitely a possibility that, the foreign taxes is not completely eliminated. It's only mitigated.
And a lot of times we say mitigates part or all. I've seen that language. I'm not sure if it's in the regs but it says mitigates part or all. And for the reasons Jim just said.
Okay, good. No, I'm sure our audience appreciates that, and your just your experience in the matter. So yeah, that's good to hear. Thank you very much. All right. And audience, again, thank you so much for all of the questions. We are getting a number of these in, so please bear with me if we have to take a couple minutes or a few seconds in between these questions, but we do really appreciate it. So thank you so much for inputting your questions. All right, Maria, we have another short one for you.
Okay.
And this one is simply, what is the pre-credit amount?
Well, that would be the tax before credits. In looking at the 2022 form, that would be line 16.
Okay, so just kind of a terminology question.
Yeah, pre-credit. So it would be the base, the tax before any credits.
Okay. And then similar to that, there's a question about exemptions that you might have referred to.
Yeah, I saw that. And it depends on, you might be working on a year that had exemptions. We don't have exemptions anymore. That's probably just a terminology we had in our discussion that we should probably take out because nobody gets exemptions anymore. So.
Oh, okay, I see. Okay. All right, so let's see. Okay, Jim, I apologize for giving you all the complicated ones, but this is a long one, but it looks like a pretty good question too. So let me read this out and let me know if you need any of this repeated. All right, so it reads, taxpayer received foreign W-2 from China in February with tax withholding of $15,000. The taxpayer expects the W-2 tax liability is $16,000, and he will make the tax payment of $1,000 difference when he files the foreign tax return later this year in 2023. Now, if this return is prepared and filed in April of 2023, so this year, should the amount of $15,000 or $16,000 be used to calculate the foreign tax credit? I think, yeah, if you're able to read the text on that one, you might be able to see that in more detail. It's kind of long, so feel free to let me know what you think there.
Yeah, I'm going to assume the the 15,000 tax withholding was the taxes were withheld in the prior year, let's say 2022 tax year, and then the taxpayer or the tax preparer is about to file the return in 2023 for the 2022 tax year. Now, if the taxpayer is using the paid method, and I think most cash basis taxpayer, individual taxpayer will use the cash method or the paid method, then on the 2022 return to be filed in 2023, only that which was actually paid, the $15,000, can be claimed for foreign tax credit purposes. And I read the question is saying that there's a balance of $1,000 due. So the total tax liability to China is $16,000, $15,000 of which was withheld. And $1,000 will be paid later on after the taxpayer filed a Chinese tax return. So on the paid method taxpayer, if the taxpayer elects the paid method to claim the FTC, then only $15,000 can be claimed on the Form 1116. However, on a accrued method, of course, as Maria mentioned in her presentation, the individual taxpayer can, even though on the cash method of accounting, can nonetheless make a one-time election, be on accrued method, to claim the FTC. Once that election is made, is binding on all future years. So that's a consideration for tax planning purposes with the taxpayer. And I hope I answered that question.
Okay. No, I think, yeah, you covered really all parts of that. That's, okay, I think a helpful explanation and, yeah, a good real-life scenario, too. So, all right, thank you for that. All right, moving along. Okay, Maria. So this question, and you're lucky, you're getting all the shorter ones.
I don't know. No, that's fine.
All right, this question reads, would income earned in Puerto Rico, so a United States territory, be considered foreign income and then necessitate filing Form 1116?
Good question. There are different categories of taxpayers that get to claim the FTC. Obviously, U.S. citizens, and, we have U.S. residents, the green card holders. But if you are a bona fide resident of Puerto Rico, yes. The short answer is yes. Now, there are different rules if you're asking if they're eligible to claim the FTC. There are different rules for FEIE and things of that nature. So we're not having that discussion today, and that's another one of our practice networks. But there are different rules for Puerto Rico. But for purposes of FTC, yes, a taxpayer who's a bona fide resident of Puerto Rico can claim the FTC.
Okay. All right. Good to know, and thank you for that. All right, Jim. This question reads, if a taxpayer made a 962 election, does the taxpayer need to file both Form 1116 and Form 1118 or only 1116?
Yeah, the short answer to that question is the Form 1118 and not the Form 1116, because the individual taxpayer made that election to be subject to the corporate tax rate, and we're seeing more and more of these Section 962 elections because the TCJA lowered the corporate tax rate, I believe, to 20%. So some taxpayers are making an election so that they can be subject on foreign income to the lower rate. And as a result, if they're subject to the corporate rate via this 962 election, they would use the corporate foreign tax credit form, or the Form 1118.
Okay. So Form 1118. Got it. All right. Thank you for that. Okay, Maria, coming back your way. All right. This next question reads, is income from a foreign rental property considered in the foreign branch category?
Rental, by definition, is passive. So I would say all rental property belongs in the passive basket.
Okay. All right, good to know. Okay, Jim, all right, another long one for you. I really do want to thank our tech team and experts in the back that are going through the questions and looking for the best ones. But Jim, you do happen to get some of the longer, more complicated ones. So let me read this one out. All right, a U.S. person resides in the U.S. and provides the personal services to a foreign company which is located in a foreign country. The U.S. person is required to pay income tax under the foreign country tax law. According to the sourcing rule, personal service is sourced to where the service is provided. So the service is U.S. source. In this case, is that correct that the taxpayer is not qualified for the foreign tax credit? Feel free if you need any portion of that clarified.
Yeah, that's a very good question. I think I got the question, and yeah, you're right. Generally speaking, if the services is performed in the U.S., it would be U.S. source income, and then, of course, in this case, the foreign country also required the taxpayer to pay foreign taxes because the company is located in a foreign country. So in this case, how can you then claim foreign tax credit on income that's sourced in the U.S. because of U.S. tax principles? Now, in this case, I would it would on the surface seem unfair that the taxpayer's income here is subject to double taxation, and then if this income is sourced in the U.S., he will not be qualified to claim foreign tax credit. So in this case, I would refer the taxpayer to income tax treaty to see if there's something in the income tax treaty that would resource this income from U.S. to foreign source. And then in that case, if there is a provision in the tax treaty for such resourcing, then the taxpayer can claim the foreign tax credit on the income that's resourced. So that's the first place I would go is go look at the tax treaty with that foreign country and see if there's any provision that could provide a resourcing of this income, even though by U.S. tax principles that income is sourced in the U.S.
Okay. All right. Thank you, Jim. All right, Maria, this next question is coming to you. Let's see. This one reads, are the foreign taxes shown in Part 2 of Form 1116 assumed to be the foreign taxes paid or accrued?
From where I sit, no. You have to substantiate. Substantiation is like the first hurdle, okay? So as long as you can substantiate them, that's the first part. The second part is you have to look to see if a treaty exists with that country, and is that particular income subject to a lower treaty rate? And if so, it doesn't matter what they put on Part 2, they need to put the lower amount. So, no,
Okay.
you don't assume what's on Part 2 is the foreign taxes paid or accrued, because you have to justify whether it was the actual legal and liability, and to do that, you need to check for the treaty rates.
Okay. Makes sense. Got it now. All right. Okay. Thank you for that, Maria. Let's see. Okay, Jim, this next one is for you. All right, a shorter one for you. You'd have this no problem. Okay, the question reads, is there an election to only carry forward the credit so you don't have to carry it back?
No, the rules related to carry back and carry forward of unused foreign taxes is not an election. The carry back is mandatory. It's different from NOL carry back and carry forward, because I think in that case you can make an election to forego the carry back. But in the case of unused foreign tax credit, you're mandated to carry it back 1 year and forward 10 years. It's not an election. Post Section 904C.
Okay. Section 904C. Okay, good to know. All right, thank you. All right, Maria, switching back your way. Okay, this question reads, the taxpayer paid withholding taxes at the statutory rate. On their tax return, they correctly claimed the lower tax treaty rate, and they claimed the difference as an itemized deduction.
The answer to that is no. What they need to do is contact the withholding agent and invoke the treaty, the lower treaty rate, and basically what they have to do is file an amended return in that foreign country to get the excess back. We don't subsidize taxes that are non-compulsory. So, and that means the lower treaty rate is all we will entertain. And if there's more than that, then they need to go back to the country and say, you know, the treaty rate said this, give me my refund of the difference. Some people don't do that. It costs money to amend returns, you know, but that's the short answer. You have to go amend your return in the foreign country.
Okay. All right. Good clarification. I'm liking the straight answers too. This is excellent, guys. Thanks. And this is I think what our audience likes to hear. You know, that's no, we really appreciate it. Okay. Let's keep moving. Jim, I'm coming to you with the next question. Okay, this question reads, what if they filed Form 1116 in year 1 to report the FSI on line 1, and they defaulted to the paid box being checked, but they did not claim any foreign taxes paid? And note, there's nothing reported on line 8. And they still amend and use accrued.
Yeah, I would say without knowing more facts, I'm not really sure why the taxpayer filed a Form 1116 if they didn't make any, if there weren't any foreign taxes paid. But let's just say they did it, they made a mistake, okay? But they did, unfortunately, file a Form 1116 and a method was chosen, which was the paid method. And therefore, the only exception, and I think Maria mentioned this in one of the topics she presented, is that there's a very narrow exception to amending a tax return to change the method. And it came in the new regulation that was promulgated last year. And that's only if, I believe, Form 1116 was not ever filed. No method was ever chosen previously. But in this case, in this fact pattern tells me that the taxpayer had filed a Form 1116 and a method was elected. Therefore, they cannot go back and amend to change a method.
Right. The filing of the Form 1116 is electing the foreign tax credit. Some people, sometimes they don't check the box. And Jim, correct me if I'm wrong, I think the assumption is you're on the paid method if no boxes are checked. Say there was an oversight. But the mere filing of the 1116 means they have elected FTC.
Okay.
And I would
All right.
refer back to that Treasury regulation, and maybe we can put that in the chat box. The one that Maria mentioned earlier for that very narrow exception to amending a tax return.
I can find that. I'll put it in the chat box if I can find it real quick. Hold on.
Yeah.
So Jim, take over while I hunt for this, okay?
All right. Well, while Maria's doing that, Jim, let me ask you another question then. All right. This one reads, assuming you have the most categories of income from one country, so all the categories of income, how many Form 1116s would be attached to your return?
Yeah, if all the categories of income are in play, then I believe there are 7 categories or 7 baskets of income, different categories of income. Then you would need 7 Form 1116s.
Okay. All right. And then Maria, if you happen to have that Treasury regulation offhand, if you could just speak it out for our audience, there won't be a chat box we can access on this webinar.
I'm cutting and pasting it into, I don't know that I have the chat box, but it's 1.905-1E2.
Okay, great. And then with these webinars, so these are transcribed, so can you just give us a brief statement, just in case anybody's logging in right now, what Treasury regulation that number is again and what it's relating to?
1.905-1E2 basically now states it's a very narrow exception that if a taxpayer claims FTC for the first time, they can do it on the accrual basis on an amended return. What that means is they never, ever, in any past year on an original return claimed FTC on the paid method or on the year in question on the originally filed return. So for whatever reason, an individual decides or overlooks and doesn't file an 1116, even though they had foreign income and they paid foreign tax. Maybe it was an oversight, I don't know. But they are allowed on an amended return, if they've never taken FTC before, to do it as an accrued on an amended. So it would be the first time on an amended return that you can do an accrual basis.
Okay.
So remember, I think my example was they never ever claimed FTC in prior years. They didn't claim it on their originally filed return, and later on they found out that, oh, if I would have done this on the accrued method, I would have gotten some benefit. Then they can amend that year's return on the accrual method.
Okay. Okay. I think that clarifies it for us. All right. Okay. We got time for a few more, so let me keep this rolling. Jim, so I'll come back to you with this one. So this one's a little easy, maybe just a refresher of the terminology. So this one asks, what is the formula for the foreign tax credit limitation?
Yeah, it's the foreign source taxable income, and I want to emphasize it's taxable income because if there are deductions related or expenses related to the gross foreign source income, you need to reduce the gross by the deductions or expenses. So it's the fraction is foreign source taxable income divided by worldwide taxable income before exemption. And that formula is in part 3 of the Form 1116.
Okay, great. All right, and I'm getting a note. We have time for one more question. So Maria, let me throw one more at you. Okay, easy one. What were the two references you talked about for foreign tax credit?
Oh, that's easy. The Form 1116 instructions that's a given, but it's Pub 514. That's the one that deals with FTC for individuals.
Okay, publication 514. Okay, great.
Yes, we dream about 514, yes.
I'm sure you guys know every sentence and every exclamation point in that publication. So, all right, thank you both so much, Maria Nicolau and Jim Wu, for helping us and answering all of those questions. Our audience really does appreciate it. And audience, thank you for inputting all of your questions. That is all the time we have for questions. So thank you again, Maria and Jim. And before we close the session, let me see. Jim, do you have any key points that you want the attendees to remember from today's webinar?
Yes, Mike. I think the takeaway from this webinar is that, first of all, the foreign tax credit limitation is there. We have a formula that we showed everyone, and that's a very important formula there because the foreign tax credit limitation is there to prevent an offset of U.S. income taxes on U.S. source income because the purpose of the FTC is to mitigate, again, the word mitigate, maybe not completely eliminate, but to mitigate double taxation on foreign income, not on U.S. income. And then the next thing I would say is starting in 2021, there are 2 new schedules, B and C, which are now required to be attached to the Form 1116 if there are any carryovers or carrybacks of excess foreign taxes or if there are any foreign tax redeterminations. And then finally, I would say the takeaway from this webinar is that each category or basket of foreign source income requires a separate Form 1116, and which means also that the foreign tax credit limitation is computed separately and applies separately to each income category. Back to you, Mike.
Oh, okay. Thank you, Jim. All right. Okay, audience, we are planning additional webinars throughout the year. And to register for all upcoming webinars, please visit IRS.gov, keyword search the term webinars, and select the webinars for tax practitioners or webinars for small businesses option. When appropriate, we will be offering certificates and continuing education credit for upcoming webinars. And we invite you to visit our video portal at www.irsvideos.gov. There you can view archived versions of our webinars. Please note, continuing education credits or certificates of completion are not offered if you view any version of our webinars after the live broadcast. And once again, a big thank you to our speakers, Maria Nicolau and Jim Wu, for a great webinar today, for sharing their personal expertise and experience with us and answering all of our questions. And again, thank you, our attendees, for attending today's webinar, Practical Considerations, Form 1116. If you attended today's webinar for at least 100 minutes after the official start time, you qualify for 2 possible continuing education credits. If you stayed on for at least 50 minutes from the official start time, you qualify for 1 possible continuing education credit. Again, the time we spend chatting and discussing administrative items before the webinar started doesn't count towards the 100 or 50 minutes. If you're eligible for continuing education from the IRS and registered with your valid PTIN, your credit will be posted in your PTIN account. If you qualify but you haven't received your credit or your certificate by March 3rd, then please email us at the email address shown on your screen, bl.sl.web.conference.team@irs.gov. If you are interested in finding out who your local stakeholder liaison is, you can also send us an email using that address, and we'll send you that information as well. We would appreciate it if you would take a few minutes to complete a short survey before you exit. If you'd like to have more sessions like this one, please let us know. And if you have thoughts on how we can make it better, please let us know that as well. If you have requests for future webinar topics, or if you have pertinent information you would like to see in an IRS fact sheet, a tax tip, or an FAQ on IRS.gov, then please include your suggestions in the comments section of your survey. Simply click the survey button on the screen to begin, and if it doesn't come up, just check to make sure you disabled your pop-up blocker, or wait a minute to see if it does come up. We really do appreciate when you complete those surveys for us. It's been a pleasure to be here with you, and on behalf of the Internal Revenue Service and our presenters, we would like to thank you for attending today's webinar. It's important for the IRS to stay connected with the tax professional community, individual taxpayers, industry associations, along with our federal, state, and local government organizations. You make our job a lot easier by sharing the information that allows for proper tax reporting. Thanks again for taking the time out of your day to attend today's webinar. We hope you found the information useful, and you may exit the webinar at this time.